This is video part 2 on sample problem number 6. It relates to the highlighted portion here. James contributed $6,000 to his traditional IRA, and he has basis in his IRA for prior non-deductible contributions of $1,580. Know that on 1040 we need to report adjustments to income from Schedule 1, line 22. Let's go to Schedule 1, line 22. It's right here. It's the total adjustments to income, which consists of IRA deduction. Let's learn a little bit about IRA deduction. There are two main types of IRA, traditional IRA and Roth IRA. First, what is an IRA? It is basically a savings account that earns interest, and pretty good interest. With a traditional IRA, you put money called contributions into the account. The money that is contributed will not be taxed because you could deduct from taxable income. Interest earnings are compounded in the account. It's not taxable. When you take money out at so-called retirement, 59 and a half, it will then be taxable. With a Roth IRA, it is not deductible. So that's opposite of the traditional IRA. You cannot deduct contributions from taxable income. It is taxable. Like a traditional IRA, the interest earnings compounded in the account are not taxable. But unlike traditional IRA, Roth IRA distributions are not taxable. How much money could contribute into these two IRAs? $6,000. But you could contribute $12,000 if one of the spouse does not work or does not earn income. Limitation is that total contributions cannot be more than the earned income of salaries and wages. Anyone 50 or more in age could contribute an additional $1,000 per year. For the traditional IRA, the $6,000 contribution allowed would be reduced if the taxpayer contributes to another IRA. For Roth IRA, it does not matter. One could still participate in another IRA and would still be able to contribute up to $6,000. For both IRAs, the maximum annual contribution is subject to reduction when AGI reaches a certain threshold based on filing status. You do not need to remember the threshold, but you could refer to the tables in your book. Again, the max amount of contribution is $6,000, a catch-up of $1,000 for taxpayer that's age 50 or older, so that would make it $7,000. Can you contribute both traditional IRA and Roth IRA? Yes, but the combine of both is limited to a max contribution of $6,000, or if you include the catch-up, it would be $7,000. For traditional IRA, which we know is deductible and is subject to phased out when those that earns very high income, so high that it may not be deductible for them, so it lacks the tax benefit of reducing taxable income. However, there would still be a benefit, and that benefit is the interest earnings in the account. Interest that is earned on top of interest. These do not get taxed. Only taxed when the taxpayer takes money out by way of a distribution. In this case, the traditional IRA becomes a non-deductible IRA, cannot deduct contribution from taxable income, but the interest earned are not taxed until later. A Roth IRA example. What is the maximum contribution to a Roth IRA? It's $6,000, right? So in this case, the taxpayer has AGI of $126,000, which is very high. He may be subject to phase out. The filing status is single. We need to look at the table on page 5-9. On the table for Roth IRA, filing status single, the AGI phased out range is $122,000 to $137,000. Range is $15,000. $137,000 is the upper limit of the range, and $122,000 is the lower limit. And the range then between the two numbers is $15,000. Keep that in mind. So take the upper limit, $137,000, minus the taxpayer's AGI given in the problem. Divide by the range, $15,000 in the denominator, times $6,000, which is the contribution max amount, and we get $4,400 as the amount of allowable Roth IRA contribution. Another example, this one is on the traditional IRA contribution. Both Lisa and Mikhail are married, both 41 years old. They filed their taxes jointly. Lisa is covered by a 401k plan at work and earns $96,000. Mikhail is not covered by a plan at work and earns $30,000. So both work. One has a 401k plan, the other does not. Using the table on page 5-9, how much can each of them contribute to a traditional IRA? Let's take a look. The scenario in this problem falls under this situation. Married jointly with one active participant, right? This married couple, only one of the spouse is an active participant, has a 401k plan, the other do not. So each of them have a different separate range that they need to follow. Their joint income is $126,000. Now, for Lisa, who is the active participant, her range is $103,000 to $123,000, and the joint income is $126,000, so it's above this range, and she is completely phased out, will not get any qualification for the contribution, whereas the other spouse, Mikhail, is a non-active participant. He doesn't have a 401k. His range is different. It's from $193,000 to $203,000. The joint income is $126,000, so it doesn't even fall into this range. It's way below it, and therefore he can make the full $6,000 traditional IRA contribution. Can a taxpayer convert from a traditional IRA to a Roth? Yes. Why would someone want to do that? It's mainly because of tax. With a traditional IRA, when will you get taxed? When you take a distribution, and typically 59.5 is the age. If you expect your income to be high at retirement, is that favorable? No. So then you may want to convert to a Roth IRA now and pay the tax now at the current income tax rate instead of a higher tax rate later on. So the reasons to convert from traditional to Roth IRA are lower tax rate now, expect higher tax later. Negative taxable income, same as having low income tax. Many years to retirement, so convert it now while income tax is lower than in the future. Can you take money out of your traditional IRA before retirement? Yes, and of course, it will be subject to income tax. In addition, there is a 10% penalty for taking it out before age 59.5. I have been referring to retirement as 59.5. That's what I mean. The retirement age is 65 or 67, and that may change, but in terms of IRA and 401k plan, it's age 59.5 before you can take it out without penalty, okay? There is no penalty if there's a special reason due to disability, using it for medical expenses, being unemployed and paying medical insurance premium, paying for college tuition, buying a home for the first time, or the limited to 10,000 distribution, and so forth. The government encourages people to have a savings plan for retirement, and that's why they ease up on tax as an incentive when it comes to retirement accounts. Employers that contribute to the retirement plans on behalf of their employees, they match amount that employee contributes, they get to deduct it. The employer gets to deduct it from their income. So it reduces their taxable income. Think of having income that's taxable and then reduced it by expenses. So it's just the same idea, right? What the employers contribute to on behalf of the employees are not taxed right away. So there is more money in the account to earn interest. it is tax deferred until the employees take it out, called distribution.